Hello everyone. Thank you for joining us for today's webinar, 7 Ways to Save on 2016 Tax Returns for Traders. My name is Rob Lipson. I'm one of the Senior Sales Rep and Business Development VPs of Lightspeed. We thank you for joining us today. We're proud to present here today Robert Green of GreenTraderTax, GreenTraderTax.com, one of the foremost authorities on tax services and filing for day traders and investors and alike. He's been one of the authorities for a long time now. We're happy to have him. You certainly could check out GreenTraderTax.com. There are a lot of other educational webinars, events, tax guides, and tax tools, along with a lot of other services that they provide. So we are very happy to have him back. He's been doing this for a couple years for Lightspeed, and the response has always been fantastic, so we are certainly happy to have him. Before we get started, I just have to do the brief compliance disclosure here, if you guys wouldn't mind. Lightspeed Trading is not affiliated with these service providers or any of the presenters here. The data, information, and materials provided for informational and educational purposes only. The content neither is nor should be construed as any offer, solicitation, or recommendation to buy or sell the securities, or any trading, or any investment advice. Any investment decisions is made by the user through the use of such content is solely based on the user's independent analysis, taking into consideration your financial circumstances, investment objectives, and risk tolerance. Lightspeed does not endorse, offer, or recommend any of the services provided by any above providers, and all trading strategies solely should be based on the independent analysis of the user. Well, with that being said, I'm going to turn over the microphone to Robert Green, and he will begin the presentation. I hope everyone will take a lot of notes here and really take note of what he has to say. And also please note that the webinar will be recorded and posted to the Lightspeed website in a couple of days as well in our webinar section, so you certainly will be able to review it at a later date as well. With that being said, I will turn over the microphone to Bob, and here we go.
Thank you very much, Rob. Can you hear me okay, Rob?
Yes, sounds great.
Good. I just took the screen and I see my screen okay. So let me just minimize and start the PowerPoint deck. Let's get started. 7 ways to save on 2016 tax returns for traders. Well, that's what you're working on now. The 1099-Bs are just coming out from the brokers. Our team of CPAs, about 10 to 15, are real busy now. The 1099s just came in and they're working on last year's tax returns, which are due April 18th this year, or you can file a one-page extension. So here are some ways to save money as a trader. Keep in mind that I'm the managing member of Green, Neuschwander, and Manning LLC, our CPA firm, and the CEO of GreenTraderTax, our website, and I'm a CPA, a certified public accountant. My job is founder and CEO, publishing company, managing member of the accounting firm. We cater to traders and investment managers. Why focus on traders? Because trading is a real professional and other tax professionals and solution providers underserve them. Caring for traders is an excellent mission. I focus a lot of my time on content. I was up late last night with a major forex update coming out tomorrow with the FXCM news. So we're always staying on top of the latest things happening in the trading industry. You can read my guide, the Green's 2017 Trader Tax Guide. It's updated every year since 1997, 20 years now. Barron's recommends it every year. The hardcover book was 2004 from McGraw-Hill. I write for Forbes. I used to write for Active Trader magazine and leading brokerage firms. Lots of people feature our blog contents. Lightspeed does as well. The media recommends us the most. You'll see our interviews everywhere. And we teach trader tax and these issues at Traders Expo and to other accountants. Thanks, Rob, for the disclaimer. I have it too. This is educational. It's not intended to be a substitute for specific individualized tax, legal, or investment planning advice. Where you need the advice, you should get it, like from CPAs in our firm. Robert Green and Green Companies are not affiliated with Lightspeed Trading. Now note, this presentation is based on current tax law, and tax reform changes are expected in 2017. The webinar agenda: tax software and preparers come up short on traders. They mishandle trader tax status. IBM Watson doesn't know traders, probably learning our guide, but doesn't know how to navigate the nuances of, do you qualify for trader tax status? Is an entity good for you? What elections you should make? It's very complex stuff, and your local tax preparers don't know it. Your local CPAs don't know it. They don't have a lot of trader clients. They don't want to learn all these arcane rules and stick their neck out on the line, for example, going against a 1099-B, which maybe you should be doing, but your local accountant is afraid to do. So we're going to cover the forms, the elections, the tax treatment of different financial products, entities, employee benefit deductions like health and retirement, and if you don't have trader tax status, investment expenses. So let's talk about these 7 powerful ways. Step number 1, you got to use the correct tax form, folks. Errors on tax forms lead to IRS notices and exams. A lot of traders used to put trading gains. They think they have trader tax status. They go to the local accountant. They say, I have a business. The accountant says, okay, let's use Schedule C to report your trading gains. That's a guaranteed audit, folks, or your losses. Guaranteed audit. And then you could lose trader tax status because you botch how you talk about your trader tax status to the IRS. So keep in mind, if you're a sole proprietor trading business, other sole proprietorship businesses report revenue, the cost of goods sold, and expenses on Schedule C. So your local accountant may think to do that, or you may think to do that. But business traders qualifying for trader tax status report only expenses on Schedule C. Trading gains and losses are reported on various forms depending on the situation. If it's a sale of a security, you got to use that complex Form 8949 with the cost basis reporting. It feeds into Schedule D with the cash method or the realization method. The capital loss limitation applies at $3,000. And otherwise, you're going to have a capital loss carryover against the next year's capital gains. Now, remember, capital losses are unlimited against capital gains. The $3,000 limitation is only against your other income. So you got to report correct wash sale loss adjustments, and we're going to cover that more later, and other cost basis adjustments like corporate adjustments like stock splits and dividend reinvestments and the like. Section 475, mark-to-market accounting, which if you've never heard of it, folks, that's one thing you want to take away from this session. That's tax loss insurance for traders. That gets you out of the capital loss limitation, gives you a big business loss. That goes on Form 4797. Business traders who elect and use 475 on securities report their trades line by line still, like 8949, got to report each trade, on Form 4797 Part 2. MTM, mark to market, means that your open business trades are marked to market at year-end based on year-end prices. A lot of active traders don't have a lot of open positions. That's not a big concern. You can't use mark-to-market on those losing positions that are investments that you've been holding on to for a year or two. You can't slip those into mark-to-market. Those are segregated investments. So Form 4797 Part 2 is ordinary gain or loss, not capital loss. So no capital loss limitation, no wash sale loss adjustments. You're extricated from those 2 pitfalls. And you get unlimited business ordinary loss treatment, avoiding those pitfalls that I just mentioned. Now, Form 4797 losses are counted in net operating losses, NOL calculations. NOLs can quickly generate quick carryback refunds. Your 2016 tax return has a loss of $100,000. Your wages were $50,000, so now you're minus $50,000. You can carry it back, and your wages were $50,000 because you left the job in January or February, and then you traded the rest of the year. You can carry that loss back to 2014 and 2015 when you had the big wage income and get a big refund with interest. That's an incredible benefit. We've gotten $1 million refund checks for clients with these carrybacks, but you got to have rock solid trader tax status. You had to absolutely elect 475 on time and do everything right. Now, what if you're trading Section 1256 contracts that have tax advantages? That goes on Form 6781. That includes your futures and your broad-based indexes. Broad-based means made up of 10 or more underlying instruments like the S&P 100, 500, NASDAQ, all those securities indexes, the E-minis. Those are broad-based non-equity options. They're 1256 contracts. Don't confuse that with your exchange-traded funds like the SPY. Yes, those are also the NASDAQ 100, but it's a securities ETF, and that's taxed as a security with the cost basis reporting. More on that later. Section 1256 trades rely on a one-page 1099-B showing their net trading gain or loss, aggregate profit or loss on contracts, it says, and just enter that amount in summary form on 6781. You're good to go. It's a tax breeze. You have a large, if you have a large Section 1256 loss, consider a Section 1256 loss carryback election to carry back those losses 3 tax years, but only applied against Section 1256 gains in those years. You cannot carry back a securities capital loss. You're stuck with a $3,000 loss limitation against other income, and then the rest is carried over. What you can carry back is a 475 loss, which could be on securities with trader tax status, or without trader tax status, or without a 475 election on futures, you can carry back this 1256 loss. Those are the only 2 times you can do a loss carryback. You never want to miss the boat on that opportunity, folks. A lot of people miss this election, and then they file a late return, and it's too late to do it. Now, if you're trading Forex, look for this update we have coming this week. It's a major one. But it's Form 1040, line 21 for Section 988, ordinary gain or loss. If you don't qualify for trader tax status, line 21, other gross income or loss. Traders who qualify for trader tax status should use Form 4797, Part 2, ordinary gain or loss. Why? What's the difference? Well, Form 4797, Part 2 losses contribute to NOL carrybacks, that great thing I just talked about. And/or carry forward. You carry back 2 years and/or forward 20 years against any type of income. It's very powerful. But if you don't have trader tax status, you might end up with a wasted negative income. So your income was $20,000, you lost $30,000 Forex, you have negative taxable income. It's wasted. It's not a capital loss carryover, and it's not an NOL. Now, Forex may qualify for reporting on Form 6781 for the lower 60/40 tax rates. You have to make an internal capital gains election on a contemporaneous basis. And then on the major currencies only, you can use 6781. There's summary reporting. There's no 1099-B. And use the broker's online tax report. I don't want to dwell on Forex today because most of you on this call today trade securities with Lightspeed actively. And let's focus more on that, like the wash sales coming later on. So that was number 1, the correct tax forms. Number 2, maximize business expenses and fix Schedule C problems. So a trading business Schedule C, that's where you qualify for trader tax status. And we've covered that in our other content, just to, again, you trade 4 to 5 times a day, 4 to 5 days a week, 4 hours a day, day trades, swing trades, patent day trader account size, intention to run a business, serious equipment, business expenses, and a home office. That's chapter 1 in my guide. You got the trader tax status. You're an active Lightspeed trader. You're a day trader, a swing trader. You're qualifying. You can claim this Schedule C after the fact. But it's going to be a red flag, and you got to remove the red flag. First of all, you want to get every business expense in you can get, because that's going to lower your gross income and lower your taxes across the board. We're not talking about investment expenses, folks, below the line. We're talking about business deductions. So a sole proprietor business traders report business expenses on Schedule C and trading income loss and portfolio-related income on other tax forms. So it confuses the IRS. Here, they're going to automatically view a trading business Schedule C as unprofitable, even if it has substantial net trading gains on other tax forms. The computers are going to flip out. The computers are going to audit you. They're going to say, what's this Schedule C business with all expenses and no income? That's one reason why I recommend the entity, because it's all consolidated on the entity return. Right on the face of the return, it shows the income and the expenses and the net income that you're profitable. So we advocate an income transfer strategy. It's not in the tax forms, it's in our guide, it's industry practice. To mitigate this red flag, I advocate a special strategy to transfer a portion of business trading gains to Schedule C, to zero it out if possible. So if you have $20,000 of business expenses, including home office, on Schedule C, you don't want to show a big loss, and the home office is not allowed unless you have income. So with the transfer of $20,000, where you had, let's say, business trading gains of $50,000, so you just transfer $20,000, and it goes to line 6, other income, all of a sudden your Schedule C is zero. Now, don't report a net income on Schedule C. Don't transfer more income than you need, as that would invite the IRS computers to look for self-employment tax, which traders do not owe unless they're full members of an options or futures exchange trading 1256 contracts on that exchange. Now, you got to explain this in the footnotes. I strongly recommend that business traders always include well-written tax return footnotes. That's what we do for our clients, explaining trader tax law and benefits, why and how you qualify for trader tax status, business treatment, whether you elected Section 475 MTM or opted out of Section 988, and other tax treatments such as the income transfer. You got to nip all the IRS questions in the bud so that you don't get a tax notice and you sail through. The IRS gets a copy of your 1099-B. It's a whopping big 1099-B that a lot of you get from Lightspeed. And they're going to see all the trades. They're not going to mess with you if they see that, hey, the trades are right there. This person probably qualifies for trader tax status, and they see the explanation of everything. So you're using the right reporting forms, the right strategies, the good footnote, and the 1099-B backs it up. A futures trader 1099-B is just a one-page summary. They don't see all the trades, but your footnote explains all the trades for forex too. Now, number 3. Use correct tax treatment on different financial products. There's a bevy of products to trade. Now, the tax treatment affects the timing of income and which tax rates you use. There are higher rates, lower rates. Do you report it this year, next year? Is it mark-to-market, deferral? So most financial instruments, including securities, 1256 contracts, options, ETFs, indexes, precious metals, and Bitcoin held as a capital asset, that's what traders do, you hold it as a capital asset, are subject to capital gains treatment. But by default, forex contracts and swap contracts are subject to ordinary gain or loss treatment. The distinction can make a major difference. If you have a big loss, you like the ordinary loss treatment. The capital loss limitation is a problem for traders. They have trouble using up the capital loss carryovers. Traders with trader tax status in 475 have business ordinary loss treatment. That's refunds faster. 1256 traders enjoy the lower 60-40 rates. 60% is a long-term capital gain. 40% is a short-term gain due to the blended rates, and they're about 10% different throughout the brackets. The blog I have coming out this week shows all the brackets with the 60-40 rate. So quick summary. Your securities use the realization method. The short-term and long-term capital gains. You hold it for a year, you get a long-term capital gain. Those tax rates are almost half as much. In the 10 and 15% bracket, it's 0. In the next brackets, it's 15%, and in the top bracket, it's 20%. The top ordinary rate is 39.6, effectively 40%. It's half the rate. So 1256 is mark-to-market 60-40 rates. Options depend on the underlying instrument. And there's a difference between simple versus complex trades that include your spreads. So if it's an equity option, it's a security. If it's an index option or a futures option, it's a 1256 contract. If it's a securities ETF option, it's a security. If it's a commodities ETF option, it's $12.56. I have all that laid out on our website under the Trader Tax Center. I know Lightspeed used to link to the Trader Tax Center. I'm not sure if they do anymore. ETFs are taxed like securities when you sell them. So that's tax treatment. Makes a big difference. You got to know what you're trading and what the tax rates are and how the treatment goes. A lot of local accountants and preparers will get confused about that. And not every 1099B reports it correctly. You got to stay on top of it. If you're entitled to $12.56, you don't want to miss out on that. Now, number 4, maximize benefits on an entity tax return. Some of you have worked with us. We determined you have trader tax status. You wanted to deduct health insurance without any offsetting payroll tax cost. It's just a pure income tax deduction. Incredible benefit. A sole proprietor trader can't deduct health insurance. They don't have earned income. You want a retirement plan deduction, set the money aside, get a huge deduction for it, greater than the payroll tax cost, and then trade it tax-free until retirement. Incredible benefit. You need the entity for that. So your pass-through entity tax returns look better to the IRS. Partnerships file a Form 1065, S-Corps file a 1120S. The 1065 is filed by a general partnership, could be spousal owned, or a multi-member LLC choosing to be taxed as a partnership. In your retail trading companies, you don't take in outside investors. This is spousal owned, maybe some adult children or minor children if you discuss it with us. The Form 1120S is filed for an S-Corp and an LLC electing to be taxed as an S-Corp. Form 1065, 1120S, they issue a K-1. They're to the owners, so taxes are paid at the owner level rather than at the entity level, thereby avoiding double taxation. Never use a C-Corp in a trading business. There's double taxation, no investment expense deductions, so it doesn't cover up for not having trader tax status. You only really want these entities if you have the trader tax status. So the Schedule K-1 passes through ordinary income or loss, mostly business expenses. It's summarized on Schedule E. So you're going to have your trader tax status business expenses as one big number on Schedule E in summary form. It's going to look like you're in a hedge fund or something or private equity. It's going to look good to the IRS. And maybe you'll have some unreimbursed partnership expenses like home office. That looks a lot nicer than the Schedule C that had all that detail and no income on the form, and you had to do all those gyrations to make it look better. Now, if you have Section 179 depreciation, that's on Schedule E as well as the UPE. Now, portfolio income is passed to Schedule B, capital gains income is passed to Schedule D, and there's no passive activity loss worries, folks, because under the trading rule, trading entity is not a passive loss activity. So it's a nice way to house your trading business, to have clean tax reporting, and with the S-Corp, go a step further to unlock the employee benefit plan deductions to maximize them. So using an S-Corp, TTS, trader tax status traders, can arrange the health insurance and the retirement plan deductions. S-Corps provide additional tax breaks, including opportunities for employee benefit plans, including retirement plans and health insurance. 2 breaks that sole proprietor and partnership traders can't use unless they have another source of earned income. So if you come to me and I say you qualify for trader tax status, that gives you the business expense treatment as a sole proprietor. There's still time to elect 475 mark-to-market this year by April 18, 2017, effective January 1, 2017. You're good to go on the main 2 pillars of trader tax status. Do you need an entity? Well, do you have health insurance? Yes, I do. But I'm covered under my spouse's plan. Do you want to do a retirement plan contribution this year? You know, I don't want to do that. Well, you don't need the S-Corp this year. Where I have a large health insurance that I pay with Obamacare, and I absolutely want a deduction for it, So I need the S-Corp, and I want the retirement plan to boot. Now, health insurance is a great deduction through a trader S-Corp because there is no payroll tax due on the portion of W-2 wages. It's a quirky deduction. Whether it's the S-Corp is profitable or not, you're going to take the deduction. You're going to add it to the W-2, box 1, but there's no payroll tax. The officer is going to deduct the health insurance again on the individual return where it's offset against the wages. You wind up with a deduction on the entity return because it went through officer's compensation. I don't want to go through the weeds here, folks. Go back and look at these slides in the recording. As you're watching the recording, pause it and read the slide. The bigger savings is with the retirement plan deduction. If you have sufficient trading profits by Q4, you're not going to do any payroll until Q4. You want to wait and see how you do for the year. You can have a great Q1 or Q2, but traders know you can lose it all in Q3. Don't worry about estimated taxes during the year if you have this strategy. If you do payroll in December, you can do withholding on the payroll, which is treated as being ratably made throughout the year, so there's no underestimated tax penalty. So you're going to call us up in December and say, Bob or Adam or Darren or any one of our CPAs, I just made a few dollars this year, but I want the health insurance deduction, so let's do the payroll for that before year end. We execute it. Or, hey, you know, I made 25, 30, 50,000. I want to do the elective deferral on the 401k, the 18,000, or if I'm 50 or older, another 6,000 up to 24,000. Let's do that. And I can fund it from profits. But if I had a great year and I want to max out on the retirement plan, then I'm going to do the profit sharing plan too, the second slide. So you're going to start with 100% deductible elective deferral, 18,000 for 2016 and 2017. That's going to be paid by January 31st, 2018 through payroll. So you can wait until the end of the year. You're not funding this stuff until the last minute. And then this part is going to go through, you're going to have payroll taxes, but the income tax deduction is 100% deductible. So if you're in any kind of decent tax bracket, you're going to save a lot more income taxes than you pay in payroll taxes, putting several $1,000s in your pocket net. Uncle Sam is going to pay you several $1,000s to put money in your retirement plan where you're going to save a bunch of income taxes, pay back a little payroll tax, which goes to your credit in retirement, Social Security and Medicare benefits. So you're replacing bad income taxes with good payroll taxes, but net, you're putting thousands of dollars in your pocket. So you're going to go for the gusto, the home run with the profit sharing plan if you have a great year and make a lot of money. Then you're going to consider increasing payroll in December for a performance-based bonus to unlock a 25% deductible solo 401k profit sharing plan that you don't have to fund until September 15th of the next year, 2018, if the S-Corp's on extension. The maximum PSP is 53 for 016, 54 for 017, 50 or older, another 6 for the ED. So basically the total for 17 is $60,000. That's a nice deduction, folks. And the S-Corp gets the profit sharing plan portion of the deduction. The elective deferral portion is subtracted off of your W-2 income. That's where the deduction is. So 6. File and report tax elections on time. These are real powerful. I get too many calls from people who missed the boat. You're going to, let's say you don't get with me before April 18th. You talk to your local accountant. They're a deer caught in headlights. They don't understand trader tax status this election. They tell you to skip it. You skip it. You don't file it by April 18th. And then you realize you have a huge loss and want it, and you're out of luck. There's nothing you can do after the fact, because you can't use hindsight in a private letter ruling. You're totally out of luck. So you got to consider that 475 election by March 15th for an existing S-Corp or LLC partnership, and April 18th, because that's the deadline this year, for an individual existing. A new entity has 75 days from inception. The forex election you can do any time. So the 475 election can be confusing because New taxpayers, such as a new entity, file 475 elections internally within 75 days of inception, but existing taxpayers file a statement, the election statement, by the due date of the prior year tax return, that's April 18th for filing your 016 return or extension. And then there's a second step. You've got to perfect it later on, filing a Form 3115 with your 2017 tax return next year. That can cost several $100s with our firm to prepare. A new entity election where you adopt it and there's no 3115, it's cheaper. It's easier. It's more flexible. It's better. So you're out of luck for 2016. It's too late for 475 for 2016. You're stuck with capital loss carryovers. You may be able to claim trader tax status business expense treatment, but you might only have $5,000 or $10,000 of expenses, and that's not your biggest interest. You'll take it, but you're more concerned about turning that $100,000 loss from 2016 into an ordinary loss. Sorry, you're out of luck. You didn't make the 475 election on time. The next opportunity to elect is March 15th for an existing partnership in S-Corp and April 18th for an individual. If you are going to be down in Q1 2017, you want to make that election, even if you have a capital loss carryover. You can form an entity for a do-over to get back to capital gains to use up the capital loss carryover. What I just said is so important, but I don't have a lot of time to dwell on it. You need to read Chapter 2 of my guide where I go through this decision-making rationale when you have the large capital loss carryover. Too many people make the wrong decision, and you got to read the guide to make the right decision. So I recommend a 475 election for ordinary gain or loss treatment on securities to avoid the capital loss limitation and wash sale loss adjustments. If you have a large loss in 1256 contracts, consider adding that to the 475 election too. You can revoke things the next year. You can set up an entity for a do-over. There's choices. So you can file this capital gains election to opt out of ordinary gain or loss into capital gain or loss and 1256 on the majors. Now, suppose you don't have trader tax status. You still want to take advantage of your investment expenses. You got to still do your Form 8949, your wash sale loss adjustments, which are coming next. But your expenses, you want to maximize what you can do with investment expenses. So you got to use investor tax status with investment expense treatment. So first, interest, margin interest. You're going to report that on Form 4952. That's where it's limited to investment income and investment expenses. And the balance is an investment interest expense carryover to subsequent years. That's good. It's not lost. The deduction is taken on Schedule A where it may be subject to the piece limitation, and it's deductible for AMT, that alternative tax. Investment expenses are different from investment interest expenses. You report investment expenses as miscellaneous itemized deductions on Schedule A. That's below the line, folks. Right away, you know you're going to get hit from every side with a limitation. There's a miscellaneous itemized deductions are only allowed in excess of 2% of adjusted gross income. Let's say your AGI is $100,000. So the first $2,000 is not deductible. The allowed amount is subject to the piece limitation, and it's not deductible for AMT. Many states also limit or don't allow itemized deductions. Investment expenses are allowed for the production of investment income. Investment expenses exclude some of the biggest deductions for TTS traders like home office, education with trading schools, seminars, travel to seminars, startup costs. Now your computers and monitors are allowed if they are predominantly used for managing investments. You got to use the listed property rules. If you're using your computer for work and for personal too, and not that much for investing, it's not deductible. Now, what if you're a short seller? Your stock borrow fees are Section 212 investment expenses if you have investor tax status, but again, if you have trader tax status, they're business expenses. Stock borrow fees are not interest expense. That's confusing from some brokers. They're investment expense. They're not investment interest expense. So that means that you might wind up with a wasted stock borrow fee rather than a carryover from an investment interest expense. there's a significant distinction with a profound impact, and that's the one I just explained. Now, there are other reporting issues with selling short. Constructive sales on appreciated positions. Brokers don't report those on the 1099-B. Your local accountant has no idea about any of this stuff with short selling. You have to make the manual adjustments on Form 8949. Read my blog post about that I just show you here. And I also cover dividends and payments in lieu of dividends, dividends issued for the short seller, dividend issues for the lender. So when you lend shares, you got to square up with what happens with the dividends. Because the lender doesn't want to give up the dividends, he wants some money back for that. And there's different tax treatment for how that's handled. Let's talk about the wash sales. This is what a headache for securities traders. All you light speed traders, listen up. You got to deal with this. I don't show this as the 8th way to save taxes because it's really the first way to botch your taxes and maybe even hurt your tax outcome. If you have multiple trading accounts, including IRAs, and actively trade securities, you likely have wash sale loss adjustments to make that your broker did not make on the 1099-B, since brokers follow different IRS rules. Now, when you do this correctly, it might put you in a worse position, but it could also put you in a better position. It depends. The moral of the story on wash sales is you got to avoid these problems all year long, now for 2017, so that you don't have this mess and problems and bad outcome after the fact when you're preparing the returns. You might see a shock surprise for last year. Don't get into that same jam for this year. Avoid wash sale losses in the first place. Avoid getting stuck with a wash sale loss at year end in taxable accounts. And avoid them throughout the year with IRAs. If you have a large capital loss carryover, then wash sales with taxable accounts may not change your $3,000 capital loss limitation, but you still must account for the wash sales anyway. Wash sales are primarily a concern for securities traders using the default realization cash method, but not for 1256 traders or forex traders. Those instruments are exempt from wash sales. So here's the problem. The IRS wash sale rules differ from brokers versus taxpayers. So the brokers have one set of rules. That's what the 1099-B is based on. And guess what? It doesn't give you what you need for your tax return in a lot of situations. In some it does, in limited circumstances it does. And by the way, most of America meets those limited circumstances. So the IRS and TurboTax and the brokerage firms don't really think it's a problem because for most investors, they don't have this problem. But you active traders have the problem. So the broker calculates wash sales based on identical positions per the one account. That's all they can be expected to do. They can't calculate it between Lightspeed and Fidelity. Lightspeed and Fidelity are not going to talk with one another. They can't. They could not. That would be a violation of confidence. And if you have multiple accounts with Lightspeed and or another broker, including your spouse's accounts, an IRA account, you got to calculate the wash sales across all those accounts and on substantially identical positions. What does that mean, substantially identical? It means between an equity and an equity option. Example. A broker 1099-B does not calculate a wash sale on Apple equity versus Apple options because they are not identical symbols. But the IRS asks taxpayers to do so because they have substantially identical positions, including options at different expiration dates. Your 1099-B may show a huge wash sale on Apple equity, but you may have had a huge gain in Apple options that absorb that loss, so you have no wash sale loss. So if you don't go the extra step to do it right, you're going to hurt yourself by just relying on the 1099-B. Now it could also go the other way, that the wash sale was created because you traded an option. It can go either way, folks. Now, Avoid wash sale losses between taxable and IRA accounts. This is catastrophic. If you're going to trade an IRA, including a SEP IRA or a Roth IRA of any kind, not a 401k, an IRA, and your own individual taxable account, a joint taxable account, your spouse's taxable account, it's all under one family. You got to set up a do not trade list to avoid permanent wash sale losses between the taxable and IRA accounts. For example, trade tech stocks in your individual taxable accounts and energy stocks in your IRA. Otherwise, you're going to get tripped up. Some people try to play it cute. Take a big loss in the taxable account. Oh, I'm going to deduct that on my taxes. Then I'll buy it back in my IRA, make back the gain, and then defer that gain until retirement. You think you're gaming the system? The IRS gamed you. You lose. You never can deduct the loss in the taxable account. There's no way to record it in the IRA account. You'll never report the wash sale loss. So avoid it with the IRA throughout the year. And in the taxable account, don't worry about kicking the can down the road. Let's say you're not trading IRAs at all. You have the do not trade list. Kick the can of that loss down the road all year long. But on 12/29 or 12/25, say, okay, I got a problem. If I keep going like this into January, I got a huge wash sale loss deferral. I'm going to break the chain on wash sale losses at year-end 2017, where you did it at year-end 2016. Our clients knew to do this, and you're not going to get back into the positions 30 days before or after. You're going to trade other substantially identical positions. You're not going to touch that biopharma stock with a 10-foot pole because you know it's a problem. You're going to trade something else. So if you sell Apple equity on 12/20/2017 at a loss, hard to think about a loss with Apple these days, don't repurchase Apple equity or Apple options until January 21st to avoid the 30-day window for triggering a wash sale loss. Make the wash sale loss disappear. That's why the brokers have to wait until January 31st to do the 1099-Bs. That's why they come later than you would think, because they got to wait for the tail on the wash sales. But again, they're only looking at that one account in identical positions. They're not looking at the full picture. So wash sale loss adjustments during the year in taxable accounts can be realized if you sell or buy. If you're short, you got to buy to close it, those open positions before year end, and you don't buy, sell them back in 30 days. Now, it's too late for you to do this for last year. You may have already fallen into this trap. Let's talk about industry practice. It's become a widespread industry practice among preparers to import 1099-Bs, and I have not heard about the IRS challenging this practice to date. If you plan to use this industry practice at your risk, it's wise to avoid wash sale loss conditions in the first place. So there are a few gaps in broker versus taxpayer rules, and maybe you can eyeball a few of the problems and fix them. The crucial period is so you don't trade with the IRA. You have a do not trade list, so you're good to go there. You know you don't have a problem. And you know you avoid your wash sales at year end, the December 1st to January 31st period, covering the 30-day window on each side, and including all the spousal accounts. And you say to yourself, Bob, I avoided a wash sale problem, and therefore I want to cut corners and just use my 1099-B. And maybe it would work for you. You can discuss that with us. But otherwise, if you trade options and equities, which are substantially identical positions, and or you have multiple brokerage accounts, including IRAs, and you know you have wash sale loss conditions that the broker will not account for on 1099-Bs, then you should consider trade accounting software or services, we offer the services, that's compliant with wash sale loss rules for taxpayers. We have a great service that does that. There's a $75 admin fee for using professional software. We have an incredible CPA who does this day in and day out. We download the original trade history from Lightspeed or a whole list of other brokers right into the program. We do all the Form 8949, Form 4797, the reconciliations, dealing with the differences in the rules and the explanations. And we look for offsetting positions for the constructive receipts, for the complex trades, for 60-40 versus non-60-40. It's a great service, and you should consider it if you are one of these complex situations. If you want to cut corners, discuss that with me in a consultation. But don't just stick your head in the sand, have a complex situation, and then cut corners. You could get into a whole heap of trouble. So let's talk about closing remarks. I'll look at a few questions. It is 5 o'clock now. It has been an hour. So what you want to do is go over to our website, go to the Trader Tax Center. There's all free information there. Check out the guide. That's a good price on that. Check out the services. Give us a call. Do chat with us and more. Go to the website. Rob, do we have time for a few questions?
Yeah, definitely.
Okay.
We have about 10 minutes if you want. Up to you.
Okay. I don't see a whole heck of a lot of the questions. Will we be able to read your updated Forex news you wrote last night? What happened, Vicki, is I came up with a more positive new angle on the blog piece and I pulled it. And I'm rewriting it. I was last night, this morning, today, and it should come out within a day or two. It's a more positive answer that's beneficial to Forex traders, and I think we have good, rock-solid support for it. Does one need to have trader tax status to opt out of 988? No. Jude, you don't need trader tax status. You need trader tax status for 475, but not to opt out of 988. Min, do we need to send all the transactions, all closed orders to the IRS? You're not sending it. Keep the broker files a 1099-B with the IRS. Your Form 8949 needs to list every trade with the realization method, and your Form 4797 needs to list every trade line by line with cost basis adjustments, including wash sale losses. 1256 contract traders have summary reporting. So do Forex traders, summary reporting. Bob, yes, all these topics are covered in my guide. Get the 2017 guide, and you'll get the download and the paperback. You'll have access to updated versions, like I might do an updated version on the Forex part and one or two other things, and I may do that real soon. So get the guide, and then always stay in touch with the blog for the latest news, because going to be a lot coming down with tax reform, and we're going to be on top of that. Samuel, yes, watch the recording tomorrow or the next day on Lightspeed. Tim, is it too late to set up an entity for 016? Yes, it is, Tim. But now's a great time to set it up for this year. So don't say, I missed the boat, so I'm skipping Bob now. I'll talk to Bob next year, because you're going to miss the boat again. You got to talk to me now. Do that 30-minute consult. It's just $160. You see, I speak quickly. The whole time I'm making notes, and I send you all the notes and the next steps. It's why I love doing it. I get to meet all sorts of traders. It's my passion. During the day, I work on content and consults and entities. I don't do tax compliance, or 10 to 15 other CPAs do that, headed up by my partner, Darren Neuschwander, and also Adam Manning. Jose, is it possible to attend day trader outside the U.S.? Don't go with an offshore Forex broker. Make sure you're compliant under CFTC regulations. We're going to write, that's part of the blog post on Forex. But you can have equity, you can have securities trades around the world, and you still got to pay taxes in the U.S. You're taxed on worldwide income. Go to the International Tax Matters section of the Trader Tax Center. Remember, folks, go to the Trader Tax Center first. There's excerpts from the guide with some of the real key points. If you like what you see and want more information, you know you got to get the guide for that. The PowerPoint deck is not available, but watch the recording and just pause it, and that's the PowerPoint deck. Harry, is trader tax status very difficult, near impossible for traders to achieve? Absolutely not. We have thousands of clients. Most of them have trader tax status. We've been doing this since 1997. Never had a problem. We are the authorities on it. You're going to work with me about it, and then you also work with our tax team. you work with me about what your plan is, what you think everything is, and then during tax compliance we look at all the facts and the evidence and we make a key analysis on it. That's how we earn our salt, Harry. That's what you're not going to get anywhere else, is all that experience on trader tax status. Get the guide, that's chapter 1. You'll learn a lot from chapter 1. All sorts of examples. Susanna, can you be considered a trader if you have a joint account? Yes. Just make sure you're listed first on the 1099 and it's in your Social Security, and your spouse can be non-active. So yes. But if you trade a spouse's account and your spouse is not active, then you can't have trader tax status because you don't have an account and your spouse is not the trader. That's all in the guide. Matthew, what is the cost of your services? Go to the website. The consult's $160. The entity is $370. The entity form, the tax compliance, if you're a trader, the upfront payment is $790. The total payment might be $1,000, $1,200, $1,500 minus that $790. We have the price schedule on the site. You start with a 15-minute tax compliance consultation with my partners. They give you a price. They have you fill out a full questionnaire. They look over your tax returns. We make sure we're a good fit together, and then you move forward with the full service. It's all explained on the site. Also call customer support to ask questions. Do chat with us. We are very responsive. We're a virtual firm. It all works like clockwork. You see the whole process on the website. Cloud-based, digital, work with clients nationwide because of that best practices, modern, advanced structure of the firm. You'll be really pleased when you take a close look at how it works. And look at the testimonials. They're incredible. Andrew C., who can set up a business for tax purposes? So you want the trader tax status. So that's why I have the consult first, the entity second, because otherwise everybody would sign up for the entity, and then half the clients I talk out of the entity, either because they don't qualify for the benefits or they don't need the benefits. I have to see a compelling tax benefit that's far greater than the cost to recommend an entity. So let me assess that in the 30-minute consultation first. Chris, what kind of entity do I need? Well, again, if you want the employee benefits, you're talking about the S-Corp. If you just want to look better than the Schedule C and have more flexibility on elections, then maybe just the partnership. Jude, is there a date for office on 016 compliance? Yes. Sign up now. If you wait too late, there'll be a sold-out sign. Then you'll have to file the extension on your own, or maybe with some consulting help from me. And then you can sign up after April 18th. But the mistake that people make is that they wait until they have all their information before they sign up. There's so much preliminary stuff to take care of to get you into our system, the engagement letter, for you to see what we need from you. You can start uploading a lot of stuff that you do have, and then you know what's missing, and we can get started on the stuff you do have. Don't wait. We're very strict. If you don't meet our internal deadlines, there's no way that we're going to rush the last week to give you the tax return, because we know that's how CPAs make errors. We have zero tolerance for errors. We have very high quality control standards, and my partner Darren Nushwanda, I admire him for the way he has set all this up, and we respect it. So Alex, I have a full-time job and trade every day in the morning. You can still qualify. Do I have to create an entity? The entity is going to look better. The IRS is going to see a W-2 on your tax return, and then the Schedule C. The entity is going to look a lot better. So yes, you should have it, but you absolutely must qualify. And the standards can't be relaxed because the IRS will be skeptical. I have all sorts of examples of part-time traders that qualify in the Chapter 1 of the guide. If you like this webinar today, get to Chapter 1. A lot of people, when they do a consult with me, they've done their homework. That consult is really time is well served. That we don't have to go over the basics. Hannah, if you do not qualify for forex trader tax, they're two different things. Do you need the entity? The entity is for looking better on business expenses, and the S-Corp is for the employee benefit plan deductions, no matter what you trade, securities, futures, or forex. You only need the trader tax status for 475. You don't need it for the 988 opt-out. A lot of questions are pouring in now, Rob, because I'm on a roll, so stop me whenever you want. But we're doing really nice here. Greg, does it make sense to have a trading entity for trading activity and a C-Corp for other business? Sure, the C-Corp can work for another business, but it's a very bad choice for trading, and keep it separate. Rob, you want to jump in?
Just a couple more, and I think we're good. The bump's coming in.
All right. Okay, Greg, does it make sense to have a trading entity? We just did that. Joe, I'm over 65, just started. You can have trading. You don't have to have salary. It doesn't have to conflict with your Social Security. You can skip the retirement plan deductions, and you probably don't need the health insurance because you have Medicare. We work with so many traders that are in college, out of college, millennials in their 30s, straddling between a job and trading on their own, retirees, older seniors. It covers the gamut. Harry, is it best for full-time day traders? Yeah, you look a lot better. Rob, I guess this is probably a good time to cut it off because we have some duplicate questions. I think we got to many of them. Someone asked about audits per year. If we have 1 or 2 exams a year for our clients, that's really high, and then we win them. We transfer the case down to our Alabama office where we know the appeals people really well. They're super educated, and we have an incredible winning record ever since inception, so much better than any standard nationwide. And we chalk that up to filing proper returns where the client absolutely qualifies for the benefits with the right reporting that's entirely defensible without any sort of like made up or crazy deductions, where everything is done legally and properly. Go ahead, Rob.
Great. Yeah, if you just want to repeat the website and the best way to contact you, and I think that could wrap us up here.
Right. I think that people see that on the screen, the GreenTraderTax. So just Google GreenTraderTax.com, and that's the website. Now, I'll be at the Traders Expo in New York City with a kiosk. You can come meet me there, and I'm doing the workshop. That's in a couple of weeks at the February 28th, and I'll be there the 26th to 28th if you're in the New York area.
Great. I'll see you there. I'll be there as well, so I'll look for you, Bob.
Yeah, that'd be great.
Okay, we thank you so much. This is such great information. I hope everyone was paying attention. I know you answered a lot of questions, so we're very appreciative for you taking the time to do this for us. Can't wait to have you back next year as well. And everyone, we certainly will have this up on the website as soon as possible for you so you can review it and really see what applies to your particular status. But definitely reach out to Bob and the website and his team, and they'll be happy to help you as well. So, Bob, thank you so much. Everyone, thanks for attending, and everyone have a great night. Thank you very much.
Thanks, Rob. Thanks, everyone.
Okay. Take care. Thank you.
Bye. Rob, do you want to dismiss me as organizer and then